Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss elections and their impact on your money. Specifically, I'm going to chat about how presidential elections impact your retirement portfolio, two resources to help illustrate this impact, the key portfolio consideration leading up to an election, two ways to help mitigate election turbulence, and lastly, as always, a few action items for you to consider. So first off, a giant disclaimer to start. This episode will not be political at all. Rather, I'm simply laying out historical facts backed by evidence. Furthermore, I will be using US electoral and market data to provide you feedback on how the US stock market performed under each political party. Now, this is a podcast for the retiring Canadian investor, so you may be wondering why I'm not discussing the Canadian market and political parties. The primary reason is that the US stock market makes up roughly 60% of the overall world stock market, while Canada comprises only about 3%. So what happens south of the border is likely to have a greater impact on your portfolio than what happens here back at home. That is, unless you're overweight in Canadian equities. If that's the case, you will undoubtedly be more impacted by political happenings here in Canada in the short term. Overweight Canadian equities in a retirement portfolio is a consistent flaw that we see in prospective clients' portfolios before going through the fundamental retirement plan process. If you want to learn a little bit more about this Canadian bias, I discuss it in episode 31 of the podcast. Now getting back to politics and your money. The anticipation building up to an election often brings with it questions about how financial markets will respond. But the outcome of an election is only one of many inputs to the market. People often ask whether they should change their investments based on who wins the US presidency. Now, it's natural for investors to seek a connection between who wins the White House and which way stocks will go. But a look at history underscores that the outcome of an election is only one of many inputs to the market. Since 1926, nearly a century of returns, the S&P 500, the US stock market, shows that stocks have trended upward across Democratic and Republican administrations. Have a look for yourself. In the episode description, you will find two resources that I will be referencing today. The first being the market and US presidential elections. This is your first reminder that when you own a stock or a collection of stocks in a fund or portfolio, you are in fact a shareholder investing in those companies, not a political party. In the grand scheme of things, the president is just one of many factors that can impact the markets. Interest rates, health crises, oil prices, natural disasters, tech advances, corporate activity, geopolitics, and political leaders all intertwine to influence the market. And regardless of the factors at play, the companies you own a piece of in your retirement portfolio are focused on servicing their customers and growing their business. These businesses are forward-looking and adapting to all of these changes to grow their bottom line, their share price, and ultimately your retirement nest egg. Over the long term, stocks have rewarded disciplined investors for decades through both the Democratic and Republican presidencies. This is an important lesson on the benefits of a long-term investment approach. So, regardless of who is in office, it's crucial to stay in your seat and remain invested. Now, the second resource in the show notes, How U.S. Stocks Have Behaved in an Election Month, illustrates how since 1926, there is no consistent pattern on the market's reaction during an election month. So, with the build-up to an election this fall, making drastic changes in your portfolio in an attempt to predict the markets is a fool's errand. Ultimately, there are two considerations that should be reviewed, regardless of the election cycle, that will help you ensure that your portfolio is able to weather all storms this world might throw your way. And those are your comfort level with risk and whether you are being properly compensated for that risk. This is all about investment allocation, and it is the first step of the fundamental retirement plan process we go through with prospective clients to address these two critical considerations. During our first step, we provide a questionnaire along with engaging you in a detailed discussion to give us insight on your comfort with risk. We also ask for objective data, including information on your current portfolio statements, financial statements, and tax information. Aside from ascertaining your comfort with risk, we are seeking to determine whether you're being properly compensated for the risk that you're taking. We do this by looking at your portfolio to determine the potential for upside returns versus downside losses. We often find that people have portfolios that are not efficiently constructed from the standpoint of risk-adjusted returns. Simply stated, they're not properly compensated for the amount of risk they're taking within their investments. This review process is especially important for those of you who are looking to retire within the next 5 years and are wanting to turn the tap on your retirement nest egg and start withdrawing from your money to live on. I encourage you to check out our fundamental retirement plan process detailed on our website. In the meantime, here are 2 ways to help mitigate election turbulence or any other major events that can have a potential negative impact on your ability to stay retired. The first step is to review your portfolio and look for weaknesses, primarily as it relates to how you are being compensated for the amount of risk you are taking. In advisor speak, this is referred to as the Sharpe ratio, or your risk-adjusted rate of return. Things can start to be a bit technical here, but ultimately, your key goal should be diversification across asset classes to help mitigate the impact of one world event on your portfolio. Now, this is where you may want to look at adding alternative investments such as private credit and private real estate to further diversify your portfolio and mitigate volatility price movements in public equity and fixed income markets that do have a tendency to cause a little bit of panic. In episode 24 of the podcast, I discuss alternative investments in length. So if you're interested in learning more about how these may fit into your retirement portfolio, I encourage you to give it a listen. The second way to help mitigate turbulence in your portfolio is to make sure you have a properly structured retirement income plan. Your income plan should be guided by 5 key tenets. First off, we want you to live off of multiple streams of income. Next, we want you to be able to live primarily off the investment income produced by your principal. Third, we want your income that you are receiving to be increasing throughout retirement to keep pace with the cost of living. And lastly, we want your income to be as tax efficient as possible. Now, proper income planning is intertwined with your investment and tax plan, and these 3 areas provide visibility into the future. And it is this visibility that will enable you to understand how your decisions today will impact your future. Done correctly, income planning can give you confidence that you're making good decisions, regardless of the next political party or world event that can draw down on your retirement portfolio. Okay, so that gets me into the action items for today's episode. First off, tune out the noise as best you can. Which, let's be fair, is near impossible in today's day and age unless you disconnect from technology completely. Political noise especially has become more and more divisive, and it only lends itself to causing more fear and anxiety about the future. Now, yes, it is important to stay informed about the political happenings of the world and to educate yourself to make an informed vote about who you think should lead. But outside of that, if you aren't very much political yourself, it really should stop there. Now, some of you may disagree, but I believe strongly that the law of diminishing returns applies to the consumption of political information. The more and more you stay tuned into politics will surely lend itself to intruding upon your relationships with your friends and family, your work, and the decisions you make with your retirement nest egg. Lastly, stay focused as a long-term investor and understand that the biggest enemy to your retirement isn't the red team or the blue team. It's you. Your emotions and the decisions you make with your retirement portfolio will have a lasting impact on your ability to stay retired. Okay, so that'll do it for today's episode. For all the links and resources discussed, please check out the link in the show notes or visit retiringcanada.ca. If you're enjoying the show, please subscribe and leave us a 5-star review in your favorite podcast app. Be sure that you're signed up for the weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.